All right. What's up, traders? What's up, tycoons? Super excited for today's video. This is going to be, in my opinion, like the second most important oil or natural gas video that you guys watch. Okay. Now, the reason I say it's the second is because I've dropped some other gems that, I'm going to link to later. But this one is really going to, change the way that you look at investing and make you guys realize what you're really capable of when it comes to investing. A lot of people bought into Boyle without a plan. What we're doing today is going to using Thinkorswim's on-demand feature, and we're going back in time a little bit, okay? Now, the reason I'm choosing this period here, January, this is about 4 or 5 months ago, all right? And this is really when Boyle caught a lot of people's interest, right? In my one-on-one coaching sessions that I do, I've had several clients that, end up, telling me that, oh, hey, I have a average share price of $10 or $11, or that's when I started buying in and I just kept buying the dip and buying the dip. And now Boyle is at $3. I'm down 5, 6, 7 figures. What do I do, right? And, I'm not some genie. I can't just make money reappear back into your account, right? I'm not a personalized financial advisor. I'm not a registered financial advisor. This is simply just a free informational and educational video. And I really think I'm going to blow you guys' mind in this video, okay? And so let's just say you think you have a plan, right? You're doing some simple technical analysis here. We're seeing Boyle is very oversold, right? It's been hovering at these oversold conditions for a long time on the RSI. And this is oftentimes when people look to buy, right? If you see here, when it was oversold previously, right, we did get a nice little rally, okay? So what we're going to do is use Thinkorswim's on-demand feature to show you guys how you can leverage your shares, okay, and use that to get yourself protection, all right? You need to have a strategy of where you want to buy, right? Not only that, but where you want to sell at, either for a loss or for a profit. Now, if you're just someone who wants to keep collecting shares over and over again, okay, there's nothing wrong with that, but you at least need to have some type of a hedge, right? Some type of protection. So that's what we're going to go over in today's video. We're going to go ahead and just, simulate buying 1,000 shares. As most of the people that I've talked to, are at least investing 5 figures into Boyle, right? So go ahead and click buy here, okay? And it'll pull up a market order. We're just going to buy, 1,000 shares of Boyle, okay, at 1041, right? So now if we come over here, we can see we have our Boyle position. Now, what we're going to do is we're going to leverage our shares here, okay? So we're going to go 1 month out. So this is January 20th. Right. This is just like the first date in January it's selected for this. And we're going to go about a month out. Okay. And we're going to sell some covered calls. Now, an important step. Okay. And I highly recommend Thinkorswim for this. It's a free platform and it's really amazing. You don't have to buy and sell on here, but you can at least use this to help gather some data. Is you want to click on the layout here. And this is a really, really helpful and important part. Okay, at least for me, whenever I'm selling options, which is what we're going to be doing to generate income and leverage the shares that we own. You want to hit prob, okay, and you want to click on probability ITM, hit add item, click on probability OTM, hit add item. I've already done this, so we're going to remove these real quick. Okay, and what it's going to do is going to give you the probability in the money and probability out the money. When you sell options, generally you're looking for the options to expire worthless. So you want them to expire what's known as out the money. All right. Now, what I like to do is I like to sell options that have an 80% chance of probability out of the money or higher. Okay, it's just that simple, right? And now that's not personalized for you. That's what fits my risk profile. Okay, maybe you want something more risky, maybe you want something less risky. Okay, the more risky, the more money you're going to be able to generate, but the higher the risk that your option contract is going to be executed. Okay, now what we're going to do is we're going to come over here, all right, and we're going to right click, and since we own 1,000 shares, each option contract is for 100 shares. All right. And since we own 1,000, we can sell 10 of these. Okay. So if we come here, hit sell, and it'll pull this up. Let me get my face out the way real quick. Okay. And let's just go for the lowest price here. All right. And we're going to sell 10 of these. All right. And we're going to generate and get paid $900. Okay. Because we own 1,000 shares, we can actually sell these. These are what's known as covered calls. We're going to do that real quick. And now we just got paid $900 for owning our shares. Now, if you think about that, okay, and you take a look at the amount of money that we invested, which is roughly $10,000, $900 is roughly, okay, 9%. So we just generated 9% returns at the same exact time that we just bought. And, if you look at the shares, they're already down just a little bit, okay? Less than, 1%. All right. So, that right there, a lot of people don't know about. Now, what I like to do, okay, and again, this is just, something that I like to do. This isn't personalized for you. Again, just information that you guys can start to, use to, do what you want with, right? Is I like to say, okay, well, I just got paid $920. What can I do with that money? Do I want to buy more Boyle shares, or do I want to get some downside protection, right? And so what you can do is you can go back to the trade tab and you can buy what's known as put contracts. Now, put contracts are option contracts agreeing to sell a stock at a specific price if it's below that price by the expiration date. So here, what we're doing is we're agreeing to buy 100 shares or sell all 1,000 of our shares if Boyle is at $14 or above by February 17th in 28 days. And here we're agreeing to sell Boyle at $10 a share if Boyle is below $10 a share by February 17th. Okay. So if you think about it, we paid like 1030 a share, right? So, or 1040 a share. So we're at 10,400, right? And then we generated over $900. So if you think about it, our average cost basis per share is below $10 a share right now. So if we were to sell Boyle at $10 a share, we would actually come out in profit on this. So, what we're going to do now is we're going to use that $900, okay, to come in here and buy puts, okay? So we'll come here, and I think if you get like 5 of these, that should be around $900. Okay, yeah, so boom. So that's $900, all right? Now, that's completely free. We got paid $900, and we're going to put now that $900 into downside protection, okay? If you want to take it a step further and actually put some new income as a hedge, what you can do is you can come in here and buy 10. Okay, and so now we're completely protected if Boyle goes down below $10 a share. And we can sell all of our shares at $10 a share, or if Boyle is at $14 a share by expiration, we can sell all of our shares at $14, for the expiration. So we'll go ahead and buy 10 of these real quick. Okay, and what we're going to do is we're going to fast forward in time now. So if we take a look here, right, we own 1,000 shares. We sold 10 covered calls at the 14 strike. We bought 10 puts here at the $10 strike price. All right. And so we'll go ahead and fast forward just a month, right? We'll come here, we'll hit February 17th, okay? And we'll hit go. And while this is loading, I'm gonna pause the video real quick. All right, so Thinkorswim On Demand has loaded now. Okay, if you take a look, we're now a month in the future. We're at February 17th, which is the option expiration for these. So if you take a look here, the $14 calls that had an 80% chance of expiring worthless out of the money, those are up 97%. So the current value of them is about 2 cents, and we got paid 92 cents per contract. Each contract is for 100 shares, so that's $92. So if you take a look, that original $920 that we collected, all right, currently we profited $895 off of that, okay? And it's, pretty much a 99% chance that these are going to expire worthless. And the reason being is because look at the price of Boyle right now. Boyle is even lower. Boyle's at $5.14 a share. Remember, we bought in over here just a month ago, guys, okay, right around this $10 price in here, all right? So, we were oversold, right? So if you were using that as a metric, we were oversold, so it kind of looked like a good buy, right? But we continue to go lower. And this is something that I mentioned in videos is that, just because something is oversold does not mean it can't go lower. Just because something's overbought doesn't mean it can't go higher, right? These are just general parameters and general guidelines that people look at, right? Is typically you don't want to buy something when it's overbought, and typically you don't want to sell something when it's oversold. But as I just mentioned, it's not going to work 100% of the time. There's no strategy that's going to work 100% of the time. So that was not a good indicator. And we had a big drop in the price of Boyle. Okay. Now take a look at what happened to our position here, guys. Okay. The total profit and loss, right? Rather than being down over $5,000, okay, on the shares, which is 50%, right? If we would have done nothing but just buy and hold, we'd be down 50%, evaporated in one simple month. But because of our option strategies, look at our actual profit and loss, $1,295, right? And all we did was spend an additional $900 of income on top of the $10,000 for like $410 that we put into this, right? So in total, we invested around $11,000 roughly. Okay, just rough math here, guys. And we're only down $1,295. Okay, so it's not like some perfect thing where like, oh, hey, you're gonna make money either way, and you're never gonna lose anything by using this strategy of leveraging your shares to get downside protection. But you know, I know a lot of people really wish that they would have been doing something similar to this or something like this, or having some type of downside protection, right? Now, you don't have to sell covered calls to buy puts, okay? That's just one way to generate income, okay, and get paid $900 in this case, just for simply owning the shares, right? And so that's one way that you can help fight the decay, okay? Boyle has a lot of decay associated with it. UNG does as well, but Boyle just a little bit more. And, you know, I have an entire video dedicated to the decay and the myths surrounding the decay around Boyle and UNG. I highly recommend watching that if you haven't watched it or you haven't heard of things like contango or volatility decay, things like that. So hopefully this was really eye-opening. All right. Now, this is just currently right here at what it's at. Because, so what we can do is we can come in here and we could close these, right? So the initial $1,800 that we put in here, all right, is now worth $3,000. So, we're up 166%. What we can do is we can sell these now, okay? And if we wanted to, we could come in here and buy more Boyle shares, right? Let's say you're bullish on Boyle and you think that, hey, this thing, I think it's going to go back up now, right? It just fell 50%. Well, now you have $3,000 that you can average down on your shares with, okay? But the big question is, all right, well, hey, if I hadn't run this strategy, I would be down half of my money, right? Is this something that I want to continue investing in? Or maybe is this something that I want to maybe see if there's other things to invest in, or maybe I want to rinse and repeat this same strategy that we just did and protect myself to the downside again, right? So that's one way you could look at it. Another way is you could simply let these contracts expire in the money and you can execute them, right? And remember, if you execute them, you're agreeing to sell Boyle at $10 a share. It's currently at $5.24 a share. So in this case, you got paid $900, okay? You invested $10,410, and then you spent an extra $900 to buy yourself downside protection. So if you think about it, right, you're really coming out of there with a $410 loss, right? And let me just pull out the calculator, do some quick math for you guys, okay, so that you guys can see that, all right? So remember, we got paid 920, right? 92 or let's just even break it down even more, 0.92, okay, per contract times 100 shares, right? That's $92. We sold 10 of those, so we generated $920, right? And then we bought 10 of the $180 puts, okay? So let's do 1.80, okay, times 10, anyways, 180, okay, times 10, all right, is 1,800. All right, we subtract that 920 out of there. We paid $880, okay, for this downside protection. All right, we have that initial investment of $10,410, right? Let's go ahead and clear this out. All right, so 10.41 times 1,000. All right, and now we're selling our shares here at $10 a share. So that'll be $10,000. So in essence, if you wanted to execute these, you lost $410 on your initial shares, and then plus the $880 right there, and you would be down $1,290, right? And if you take a look, that's kind of where we're at. This is live updating. So, it really changes your perspective on things, to see that, you could have saved yourself from a 50% loss, and you'd only be down about 1,200, right? Let's go ahead and do some math here, and let's divide this by $10,410, okay, and you times that 100, right? And so rather than taking a near 50% loss, you would have only taken a 12.3% loss, okay? And again, there's no really magic ways, okay, to always make money no matter what, okay, and always be in the green. But there are ways that you can protect yourself, guys. And maybe this video really helped you guys out. If it did, please smash that like button, subscribe to the channel. There's a really important video that I just put out about BOIL. There's something that happens basically that's happened every 2 to 3 years for the past 10 years when it comes to BOIL. All right. And it's super important. And we're coming along that 3-year time period right now. And there's a high likelihood that this could be happening sometime in the future. So I highly recommend watching that video. And here's the link to that one right now.